Hey all, welcome to ShareTreck. This is Raj here. Friends, one of the things that has caught my attention is the bond yields. I'm going to explain that a little bit, and I think everyone needs to pay attention to this because it could be like taking us by surprise if things don't go the way they should. So in today's video, I'm going to explain a few things. I'm going to talk about what is meant by the bond yield. And I'm going to talk about how the bond yield should relate to each other, the 10-year, the 5-year, and the 2-year. I'll share my theory about that. And I will also explain why the US cannot buy bonds at this point of time and what risk we face because of the weakening Japanese yen and how it will affect the various markets that we deal in. So with that said, let's get started. Welcome back, friends. When we talk about bond yields, we are talking about what is the rate of return that we get on the bonds. So typically bonds are sold, let us say if there is a 5% yield, then the bond with a face value of $100 will be sold to you at $95, with the understanding that at the end of the year, you will get $100 instead of the $95 that you paid. And that's how the bonds work. But if there's a whole lot of supply of bonds, then what would happen is the demand being constant, more bonds being available to buy, the value of those bonds will drop. So as a result of which the yields will start going up. So you will be able to get the bonds much cheaper, and as a result of which you will have much better yield. For example, earlier you bought a $100 face value bond for $95, and now because there is extra supply of bonds, instead of paying $95, you may probably end up paying $94 or $93, and therefore your yield of 5% has gone up to 6 or 7%. So that's how this works. So basically the rule is that everything being constant or ceteris paribus, an increase in demand will lead to an increase in price if the supply stays constant. Or if the supply drops, demand stays constant, still you will have the same situation. So it's all a question of demand and supply. With increasing demand, supply being constant, you will have higher prices for the commodity. In this case, we are talking about bonds. And with increasing supply and demand being constant, you will have lower price for the commodity, in this case it being bonds. So that said, when we plot a curve which connects all the dots which represent the yield of the bond at different point of time, that is called as a yield curve. So you can imagine a yield curve which spreads over time. For example, I'm going to show you some of the bond yield curves in our TradingView platform. Let's go there first. So here we are in the TradingView platform, and I'm showing you the 10-year bond. So I would say this is the yield curve that you are looking at. And if you look at the 5-year bond, this is the 5-year bond yield curve and the 2-year bond yield curve. So now, if you look at the way they are stacked, this is what I would like to explain as my theory, and this is how most people look at the bonds. So in an ideal situation, the longer you stay invested, the more returns you should get. So the yield should be higher in the 10-year and the 5-year as compared to the 2-year. So right now the situation we have is that the relationship between 10-year and 5-year seems decent because 10-year has a higher yield than the 5-year. Unfortunately, the 2-year has a higher yield than both 10 and 5 years. Now we want this 2-year yields to come down so that we can be back to a more normal kind of economic environment, and those things will start happening as the rate cuts take effect. For that, I think we'll have to wait until September. So this is the backdrop. And if you want to understand how the government tries to, how the Federal Reserve tries to control inflation, you can say that the government restricts the money supply by increasing the interest rates. And when there is less money in supply, the money's value becomes more, assuming supplies being constant. And therefore, goods supplies being constant, the value of money goes up because money is restricted. And therefore, your money can buy more of the goods than before. And this is the way the Federal Reserve tries to control inflation. And when the market is lackluster and there is no enthusiasm, there is a lot of unemployment, nobody is buying stuff and all that, then the Federal Reserve would like to boost the boost the market. And in order to boost the market, what the Federal Reserve will do is it'll buy bonds and give the money back to the people so that they can go out and spend. And when the Federal Reserve does that, that puts more money into the market. And that was called quantitative easing at one point of time. But in general, reducing interest rate also has the same effect. When you reduce the interest rate, people have more money available cheaply, and therefore they are willing to take more risk, and it can boost the economy. At this point of time, the US Federal Reserve cannot buy bonds because it will increase money supply and cause inflation. So it will be a adverse situation. Now, at the same time, we have a problem with Japan. In a March 2024 press release, the Bank of Japan, which is in a decade-long battle against deflation and economic stagnation, has almost had near zero interest rates and domestically, and that has pushed Japanese investors to seek higher yields abroad, particularly in the United States. As the largest foreign holder of US Treasury, Japanese entities held 1.138 trillion by the end of 2023. And despite Bank of Japan's recent decision to end yield curve control and negative interest rates, experts predict no immediate change in Japanese investments in international bonds. And the Bank of Japan indicated that it would maintain accommodative financial conditions, keeping Japanese government bond yields below international levels. As of somewhere in March, Japanese 10-year government bond yields were at around 0.73%, still much lower than 4.3% yield of US 10-year treasury bonds at that time when they made this particular decision. Now, you would ask, Raj, why have they kept the interest rate so low? Why can't they just increase the interest rate and strengthen the yen? Now, they have a problem out there because Japan has a high debt to GDP ratio, as a result of which, if they increase the interest rate, the interest payments that they have to pay will be significantly higher, and it could cause a big problem for them. And Japan has got a demographic problem as well, so new tax collections are also less. So Japan would like to shore up its yen without having to resort to interest rate mechanism, and that's the reason why they have been struggling with very low interest rates. And I think at this point of time, the question is, what would happen if Japan decides to sell its US bond holdings in order to get US dollars and spend that to buy yen and decrease the supply of yen and thereby increase the value of the yen? So that is a major fear. And if that happens, there would be a supply of extra US bonds and demand being constant. You know that extra supply means bond value will drop. And when that happens and bond yields rise, we will have a problem with the mortgages and the stock market. So that's the major worry that we have here. So what would happen if Japan decides to sell its US bond holdings, given that it doesn't have the ability to increase the interest rates? Well, then there would be a excess supply of bonds, and demand being constant, extra US Treasury bond supply means bond value will drop, which means the yields will go up. When the bond face value drops, the yields go up. When that happens, bond yields will raise. And when bond yields raise, we have a problem with mortgages and the stock market. Estimates suggest that Japan could have up to $155 billion worth of deposits in its reserve. And Japan spent an estimated $35 billion buying yen in March, and just over 60 billion in the 3 days of September and October 2022. Experts think that yen purchases by the Bank of Japan at the behest of Ministry of Finance are funded by dollar deposits held by Bank of Japan, which are later replenished by the sale of very short-dated US Treasuries or even bills. This minimizes the hit to the US bond market. The sale of short-dated notes, especially bills, is more easily absorbed, and the long end of the curve, which may be more vulnerable to pockets of illiquidity, remains untouched. And depending on the duration of the bonds being sold, it may possibly impact the yield curve differently. The 10-year yield is already above the 5-year yield, so we don't have any problems there. This is good in my books. The problem is that the 2-year yield is higher than both 10 and 5 years. And if we have short-term bill sales, I think we are going to look at more higher yields at the shorter duration as compared to the longer duration. And this matters a lot for Canada as well, because our fixed rate mortgages are high and they depend directly on US Treasury yields. First time home buyers generally opt for 5-year mortgage. And until those rates come down, the Canadian housing market will be stressed, and mortgage renewals will become a high-risk event in 2024, 2025, and 2026, because people are going to go from extremely low interest rates to very high interest rates, almost effectively doubling their monthly mortgage payment. And also higher yields in the bond becomes a risk factor for the stock market as well, because with very less risk, people can get more money by parking their funds in the bonds, and therefore money will move out of the stock market. And when money moves out of the stock market and the number of stocks remains the same, we have a situation where there is less money and more stocks, and therefore whatever is more has to lose value, therefore the stocks will lose value, and we may see the market melt down. So this is the fear that we have. When it's going to be triggered, I don't know. And is there a way out of this? I'm pretty sure the resourceful officials at the Bank of Japan will definitely come up with some solution. And this is where the cooperation between the central bank governors comes into play. The OECD central bank governors might probably meet and decide how to take steps forward, or maybe they're already doing that. So this is a kind of risk that is being priced in. So you have to keep this in mind when you look at the highs that are being taken by AI stocks, because there might be a lot of juice out there, but the bond yields can throw a wrench in the party. With that, my friends, I would like to bring this video to an end. I hope you liked this, and I would like you to put your comments in the comment section so that I can respond to you. I love to hear from you. Again, please do not forget to press like, subscribe, and share the channel with your friends so that we can get more subscribers. We are almost close to 20,000 subscribers. Your help will just push us across the hedge. Thank you so much. Bye for now. I'll see you in the next video.